Welcome to Breaking News to Trading Moves. You look at a company's quarterly earnings report, and there's usually an expectation of straightforward logic, right?
Right, like simple math.
Exactly. A company beats its sales estimates, brings in more revenue than Wall Street predicted, and the stock goes up. It's supposed to be that binary, that clean.
Yeah, in theory, anyway.
But when we look at the recent earnings report from Kroger, that straightforward logic just kind of falls apart.
It really does.
We have a stack of earnings calls, retail analytics, and consumer data in front of us. And our mission today is to figure out exactly why the top line can look so healthy, while the underlying business is actually under severe pressure.
Yeah, the contradiction is immediate.
Right. So we were looking at the headline, figuring out the mechanics behind it, and then identifying the specific winners and losers in the market right now.
I mean, Kroger beat their sales estimates. More money physically moved through their cash registers than analysts projected, yet the market reacted negatively to the news.
Which feels entirely backward. If sales are up, why the negative reaction?
To understand the market's response, you really have to listen to the specific language management used during their update. Wall Street scrutinizes the quality of that revenue, not just the raw total.
Okay, so what was beneath those surface numbers?
Management pointed to intense inflation pressure, extremely price-sensitive shoppers, and a pretty noticeable increase in promotional trips.
Oh, wow.
Yeah, people are no longer coming in and filling up full grocery carts with a mix of everyday items.
I picture that like a shopper who only visits the store to buy the exact items featured on the front page of the weekly circular.
The cherry pickers, basically.
Exactly. You walk in, grab the discounted eggs, the promotional chicken breasts, and then you just deliberately put blinders on.
Yeah.
You march right past all the high-margin items in the middle aisles.
Right, and in retail mechanics, those front-page deals are known as loss leaders. A grocery store operates on a really delicate mathematical model. Well, they're willing to take a financial hit on the price of milk, eggs, or poultry. The assumption is that once a customer is physically inside the building to get the cheap milk, they will also buy a premium jar of pasta sauce.
Right. Or some branded cereal, maybe a magazine.
Exactly, or high-margin deli items. The layout of the store is actually designed around this exact concept.
Yeah, they put the essentials in the back, right?
Always in the back, forcing shoppers to walk past aisles of discretionary goods.
So when consumers alter their behavior to only purchase the discounted items, that entire model just breaks down.
It shatters. You can have high sales volume, but the store is losing money on those specific transactions because the profitable items were left on the shelf.
Wow.
That structural reality is what investors saw in the earnings report. A grocery store needs a blended basket of goods to achieve profitability.
And if the basket is composed entirely of discounted proteins and loss leader produce?
The margins compress instantly. The grocer performs the labor, pays for the electricity, and manages the inventory, but walks away with pennies on the transaction.
Or sometimes even a net loss.
Yeah, exactly.
So what does this all mean? Like, for you as an investor or a trader looking at these tickers, we are taking Kroger's specific earnings report and applying it to the broader grocery sector.
Well, the grocery trade is traditionally viewed as a defensive sector by investors.
Because people always need to eat.
Right. The conventional wisdom dictates that no matter what the broader economy is doing, people still need food. Because of that, investors often park their capital in grocery stocks during inflationary periods.
Expecting safety.
Exactly, expecting safety. But the reality management just highlighted proves that steady sales do not guarantee steady profits.
Right. The top line revenue is holding steady, but the cost to generate that revenue has gone up.
Yeah. If customers actively choose cheaper private label products over established national brands, grocers are backed into a corner.
So they have to react.
They do. To protect their market share and ensure foot traffic doesn't migrate to a competitor down the street, grocers have to offer deeper, more frequent discounts.
They run more promotions?
Right. And every time a traditional grocer slashes a price to stay competitive, it directly erodes their profit margins.
I see.
The revenue might hold up perfectly fine, but the actual profit left over after all operating expenses is squeezed exceptionally tight.
When consumer habits change specifically to stretch a household budget, those funds don't just disappear into thin air.
No, they don't.
They travel to different cash registers.
Yeah.
So let's look at who stands to gain from this specific behavior, because there are definite winners when shoppers become this meticulous.
Oh, absolutely.
This is where companies operating as value retailers and warehouse clubs step in. We're looking at tickers WMT for Walmart, COST for Costco, and BJ for BJ's Wholesale Club.
Yeah, those are the big ones.
You might look at these names and wonder the value is already priced in, but we need to look at how their specific business models shield them from the margin pressure hurting Kroger.
The advantage for these names really comes down to the mechanics of scale and their structural models. Take Costco and BJ's Wholesale Club, for example.
They operate on membership models.
Right. The membership fee itself generates the vast majority of their actual operating profit. Because the profit is locked in before the shopper even enters the physical building, these warehouse clubs can afford to keep their product margins incredibly low.
Like how low are we talking?
Often capped around 14 or 15%. A traditional grocer just cannot survive on those margins.
Because the membership fee subsidizes the low prices on the floor.
Exactly. The warehouse club doesn't need to make a massive profit on a jar of mayonnaise because you already paid them $60 or $120 just to walk through the door.
Right. That structural shield allows them to win foot traffic when households are forced to stretch their budgets.
Yeah, consumers actively consolidate their trips to buy in bulk at these locations to maximize the value of that sunk membership cost.
And Walmart plays a similar volume game, right? Just leveraging its massive supply chain.
Yes. Walmart's logistics network is so vast that they can negotiate lower wholesale costs from their suppliers, allowing them to keep everyday prices lower than a regional grocer.
They own the perception of value. When you walk into a Walmart, you don't feel the need to aggressively hunt for the weekly promotions because the baseline price is already perceived as the absolute floor.
You trust the pricing.
Exactly. So you are more willing to fill a larger basket.
And that trust is a major competitive advantage. Shoppers abandon the promotional hunting behavior we saw at Kroger because the psychological friction of price checking is removed.
They just fill the cart.
Right.
So if Walmart captures the families buying in bulk to save, what happens to the shopper who cannot afford a $200 bulk trip?
That is a great point.
That brings us to the discount retail space. We are looking at tickers DG and DLTR. I want to push back on the idea of discount stores taking over, though.
Sure, go ahead.
Are households really replacing their entire Sunday grocery run with a trip to a discount store? Like, I have a hard time picturing a family of 4 buying a week's worth of fresh produce and meat at DG.
Oh, no. They are absolutely not replacing the entire trip. The behavior driving traffic to DG and DLTR is called splitting baskets.
Splitting baskets.
Okay. When grocery inflation rises, shoppers begin to dissect their shopping lists. They still go to a traditional grocer or warehouse club for their fresh foods, proteins, and dairy.
But they take smaller, entirely separate trips to discount stores.
Exactly. Specifically to buy snacks, pantry goods, household cleaning items, and basic essentials to keep costs down.
You know, paper towels and canned beans are 50 cents cheaper down the street, so you just split those items off your main list.
Right. You are willing to make 2 stops.
Yeah.
Shoppers are investing their time to drive to a second location because the monetary savings on those specific center aisle categories are worth the extra physical effort.
And DG and DLTR capture that fragmented, highly targeted spending.
They do. Their stores are smaller, easier to navigate quickly, and strategically placed in neighborhoods or rural areas where a major grocer might be a 20-minute drive away.
So they win on the margins of convenience and targeted savings.
Exactly.
Which brings us to the technology side of the equation.
Yeah.
Kroger noted they are actively investing in digital capabilities to maintain customer loyalty.
Yes, they are pushing hard there.
As grocers try to retain these highly sensitive shoppers, the technology platforms facilitating that shopping stand to gain. The tickers to watch here are CART for Instacart and AMZN for Amazon.
Right. As traditional grocers push harder into digital shopping, delivery, and building their own retail media networks, platforms that provide that infrastructure naturally benefit.
Okay, hold on. Let me stop you right there.
Yeah.
You mentioned retail media networks. What exactly is a retail media network, and how does that help a grocer survive this margin compression?
Good question. A retail media network allows a grocer to sell advertising space directly on their own app or website.
Oh, I see.
Yeah. So when a customer searches for soda on the Kroger or Instacart app, a beverage brand pays a premium to have their specific product appear at the very top of those search results.
Oh, like sponsored products.
Exactly. It's highly targeted digital advertising based on actual purchasing data. And the margins on advertising revenue are incredibly high.
Much higher than the margins on selling a physical piece of fruit.
Exactly. Grocers use the profits from these retail media networks to offset the losses they take on discounted front-page items in the physical store.
That makes a ton of sense.
Yeah, and Instacart's platform, operating under the ticker CART, helps facilitate these digital interactions and ad placements for regional and national grocers who simply cannot afford to build out that technology themselves.
So the ad space subsidizes the grocery margins, and Amazon fits into this because of their existing digital footprint.
Right. Amazon gains traction through its Amazon Fresh and Whole Foods ecosystems. They have the logistical capacity and the Prime membership base to offer seamless delivery.
Especially when shoppers are highly sensitive to price.
Yeah. The ability to build a cart online, watch the total add up in real time, and seamlessly apply digital coupons is incredibly appealing. Technology reduces the friction of deal hunting.
Building the cart on an app lets you see exactly what you are spending before you commit. It prevents that awful sticker shock at the register.
Exact.
But, for every business capturing these budget-conscious dollars, or rather, these budget-conscious funds, another business is losing them. Let's look at the other side of the trade, the potential losers.
It's a zero-sum game in many ways.
The immediate victims are the traditional grocers. We're talking about tickers KR for Kroger, ACI for Albertsons, and SFM for Sprouts Farmers Market.
These names face the exact same structural margin pressure we outlined with Kroger's earnings.
Kroger's report really acts as a mirror reflecting the entire traditional grocery model right now.
It really does. Sales might improve or hold steady on paper. But if these companies have to constantly rely on promotions, aggressive price cuts, and mailing out high-value coupons just to defend their market share from Walmart or Costco, their bottom line will inevitably suffer.
Right. Albertsons and Sprouts face similar questions around basket size, foot traffic, and whether they have any real pricing power left.
Yeah, and if they raise prices to protect their margins, the shopper just walks away and goes to Walmart.
And if they lower prices to keep the shopper, they destroy their own margins.
It is a total bind.
This pressure travels straight up the supply chain to the branded packaged food companies. The tickers here are GIS for General Mills, KHC for Kraft Heinz, CPB for Campbell's, and KLG for WK Kellogg.
Oh, definitely.
I think of this like my own everyday experience. You're standing in the cereal aisle, looking at the national brand you grew up eating, and then you look right next to it at the generic store brand.
You compare the prices.
Exactly. Eventually, the price gap between those two identical boxes becomes so wide that you finally reach for the generic brand.
Right. Branded food companies have historically relied on brand loyalty to justify a premium price.
But when shoppers become hyper-focused on price, that loyalty is tested.
Exactly. Grocery chains have spent years heavily investing in their own private label store brands, improving the quality, the taste, and the packaging.
They don't look like the old, sad white boxes with black letters anymore. They look like premium products.
Right. Now, the consumer looks at the shelf and sees a private label product that is 30 or 40% cheaper than the Kraft Heinz or General Mills option, and the quality is nearly identical.
So store brand investments apply direct pressure to national brands.
They really do. If consumers are actively looking for cheaper choices, the branded packaged food companies will lose market share unless they also increase their own promotions.
Which again hurts their margins.
Exactly. And WK Kellogg, ticker KLLG, is uniquely vulnerable here.
Why is that?
Well, while some massive food conglomerates have diversified portfolios, maybe they even manufacture some of the private label goods for the grocers behind the scenes, WK Kellogg is a pure play on branded cereal.
Oh, they don't have a private label fallback.
No, they don't. If a consumer swaps from a branded cereal to a store brand, WK Kellogg feels the full brunt of that lost sale.
Wow. Let's look at how this impacts the broader ecosystem. Our last group of potential losers involves restaurants and discretionary food spending.
The spillover effect.
Right. The tickers are MCD for McDonald's, SBUX for Starbucks, YUM for Yum Brands, and CMG for Chipotle. We know the difference between essential spending at the grocery store and discretionary spending at a restaurant. But how exactly does a grocery earnings report translate to lower foot traffic at a coffee shop?
It really comes down to the lag time between a grocery inflation spike and consumer exhaustion. A household only has so much disposable cash.
Right.
If the basic cost to keep the pantry stocked goes up, that directly reduces the spending power available for everything else.
Yeah.
But it doesn't happen overnight.
They might keep up their restaurant habits for a few months, maybe putting the excess on credit cards.
Exactly. But eventually, the mental accounting catches up. The behavioral caution we see in the supermarket aisles inevitably reaches the restaurant sector.
The fast casual dinner on a Friday night or the premium daily coffee becomes the easiest microtransaction to cut.
Exactly.
If your weekly grocery bill is $40 higher than it used to be, you offset that by skipping the $6 latte at Starbucks. It is just a mechanical adjustment.
Yeah, and Starbucks, ticker SBUX, is particularly vulnerable to this exact behavior because their product is a daily, highly visible discretionary purchase.
Makes sense.
Companies like McDonald's, Yum Brands, and Chipotle have to navigate an environment where their core customer is feeling financially constrained before they even consider walking through the restaurant doors.
They are fighting for a shrinking pool of disposable cash.
Right, and consumers often step down a ladder. They trade down from a sit-down restaurant to a fast casual spot like Chipotle.
Or from fast casual down to fast food.
Or from fast food down to eating at home entirely.
Let's summarize the core dynamic for traders who are looking at these headlines. Ultimately, the entire setup comes down to a battle between value and margin pressure.
It really does.
You have value retailers like Walmart and Costco looking structurally stronger because they are successfully capturing the foot traffic of budget-conscious shoppers.
Yeah.
Then you have the traditional grocers like Kroger and Albertsons facing an uphill battle, struggling with the reality that they must constantly discount their inventory just to defend their share of the market.
And, looking at the mechanics of this consumer behavior raises a really critical question for the long term. This isn't just about one grocery stock. It is a direct read on the U.S. consumer.
Right.
We are watching shoppers train themselves to actively prefer store brands over national brands to save money. But what happens to companies like Kraft Heinz or General Mills when inflation finally cools down? Do those customers ever actually come back?
Oh, that is a fascinating question.
Yeah. Once a family realizes the private label pasta sauce tastes just as good for half the price, that behavioral change might be permanent. Branded companies might be losing market share that they will never recover, regardless of what the broader economy does next. Shoppers are still spending money, but they are doing it with intense care, splitting baskets and forcing companies to fight harder for every single cent of revenue.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thank you so much for joining us, and we will catch you next time on Breaking News to Trading Moves.